All right, so David, we've created interest in a prospect with regard to our conversations around the three greatest risk factors. They're engaged. They want to sit down and they want to have a conversation. Walk us through how you execute that conversation when you actually get face-to-face.
Yeah, Phil, and as we've set up, the three greatest risk factors to the overall investment portfolio is my commitment. And to Mr. and Ms. Client, our commitment here at our firm is to minimize and potentially eliminate what we have found to be the three most common risks to an overall investment portfolio when working with multiple advisors. And as we've gone through that in the previous sessions, just understand that as the client has engaged in that conversation, it leads you right into what we form is the 7-step investment drill down interview. And it's real simple to have the discipline to navigate the discussion as you tee up, and I say the funnel or the bridge into that discussion. And the commitment that the advisor has to the client is to minimize and eliminate those three risk factors. So as the client is right there, the advisor would then just transition normally over into the first step of the 7. So as we go down through each and every one of them, I'm going to give you some ideas, some suggestions on how to introduce each and every one of those steps. Step number 1 is the asset consolidation conversation. The conversation with the client, let's take a look at your overall portfolio on paper without regard to who the individual advisors are, based on your station in life, based on the magnitude of the assets that are in question, and based on the volatility of the market space. It's imperative, Mr. or Ms. Client, that we look at the overall portfolio as it works with the asset in which is in question. Step number 1 is the asset consolidation conversation. Step number 2, Phil, is the conversation of asset allocation. And I like to make it real simple. I draw 3 buckets on a sheet of paper. There might be more buckets with some clients, but to make it easy, asset allocation and looking at the diversification in step number 2 is really equities, fixed income, and cash, as simple as that can be. And stepping back and asking the client, based on the overall portfolio that you might have received in question number 1, let's just say it's a total of $750,000. Step number 2 is, now, Phil, let me ask you a question. If I were to take that $750,000 and break it down into these 3 buckets, Phil, make sure each and every percentage that you were to put on this equals 100%. And get Phil to think about that conversation from an overall portfolio. Step number 2 is just having some pause, because quite frankly, the client has never thought about it like that. And if you say, what percentage is in equities, what percentage is fixed income, and what percentage is in cash, Phil might have 10 or 15 different mutual funds. He's got assets at 3 or 4 or 5 different advisors. And quite frankly, our clients don't really understand the question. I've asked this question in numerous different times in my career and have really always gotten the client to look at me. They don't have any earthly idea. So what normally the advisor stop there and say, tell me a little bit more about that, and help them understand and talk through that, because at the end of the second question, the client normally is starting to see the benefit of those 3 greatest risk factors. In other words, they're seeing that their portfolio and they don't understand it near as much. Step number 3 is real simple. It's a formula of using the word ethical, ETHICAL. And Phil, the way I phrase that to the advisor is its conversational suitability. And each and every letter of the word ethical stands for a very meaningful discussion. E, expectation of rate of return in an income stream. T, risk tolerance, and really understanding what the risk tolerance is. And a good question that I always like asking there, Mr. or Ms. Client, there's 2 questions. Don't answer the first before you hear both. If the market were to be up 20% over the next 12 to 18 months, where would you want to see your portfolio? And likewise, Mr. or Ms. Client, before you answer that, same time frame, next 12 to 18 months, market were to be down 20%, where would you be willing to be before you jump ship? Having a client think through that, what they'll normally say, like I hear all the time, is, oh, David, if everybody else is up 20%, I want to be up at least 20 or maybe 25. Likewise, market's down 20, where would you be willing to be? I changed the question just a little bit there. I don't want to be more than 5 or 8% down. Understanding how we manage money here at our firm, there's no way that we'd be able to satisfy the client in the investment arena beyond that 2 to 3 year period. So what typically will happen is they're getting dissatisfied when things start going, we're not meeting the expectation of the client. H is time horizon, and understanding the time horizons of the client. Is it 3 years, 5 years, 15 years, or longer? Understanding the time horizons. I is income and income tax, and understanding the components of, not as a tax advisor, but understanding the income tax, and the capital gains tax of what some feelings are that the client might have. C stands for constraints, and understanding the constraints and the affinities of, the loves of, and the dislikes of particular holdings and particular stocks that the client might have or funds. A, attitude for communication with respects to the investment portfolio. When are we going to talk? With discretion, non-discretionary. Do you want to hear from me more often before things are done, or is it okay to me go ahead and take care of it and then let you know about it later? And last but not least, L is for liquidity. Short-term, mid-term, and long-term. So as I use the word ethical, I've used it multiple different ways in my career. Some advisors choose to write it down on the left-hand margin of a pad, and as they get to the conversation, they fill it in. Others just go through it and understand ETHICAL and then just go through the conversation. What it really is, and what I feel like, is this conversational suitability. If I build 3 or 4 or 5 questions in each and every one of the letters, then all of a sudden when I transfer that information to my risk tolerance questionnaires and to my other forms that are compliant driven in nature, then I have equal to or more information using a very disciplined approach. Now, that's the third step of the 7 steps. The fourth step is what I refer to as CLN versus WS, capital lifetime needs versus wealth surplus assets. There's some assets that the client might have that are more on the capital lifetime needs side that need to be used to generate an income stream for their lifetime plus one other, their spouse, their partner. Understanding that there are other assets that might be in addition to those that are more of the wealth surplus. As an advisor, we manage those assets very differently. Maybe more conservative here, maybe can take a little more risk with the wealth surplus assets, or advance gift, or do something with these assets more tax advantageously, whereas the capital lifetime needs assets are assets that I need to hang on to for the income stream that it will generate for my lifetime plus one other. Step number 4, capital lifetime needs versus wealth surplus. And oftentimes advisors, what I'll do with the client is merely put a T-bar on a legal pad and separate the assets, whether they're retirement assets, whether they post-tax investment management dollars, real estate, defined benefit plans, DC plans, whatever it might be. I have a running of the ledgers on both sides to be able to articulate to the client which conversation is more pointed toward these assets, capital lifetime needs versus wealth surplus. Step number 5, the non-investable asset. What is it that the client might have that is a non-investable asset? Is it real estate? Is it apartment homes? Is it farmland? What is it that the client or business assets might have that is truly not a core investable asset that might affect the way in which we will manage these investable assets from an income stream standpoint, from a growth standpoint, from a trust and estate planning standpoint? What are the assets here that might affect ultimately how I manage this investable asset?
Right.
Step number 6, I've gone through all the conversations with the client. Step number 6 is, what are some initial ideas? I've maybe heard Phil talk for the last 20 or 30 minutes as I've interacted with them. What are some initial ideas, whether it's allocation ideas, whether it's diversification ideas? Step number 6 is getting to the point of where we're bringing it home to the client. Phil, based on what I heard you say, it seems like to me we're leaning this way. I'm now trying out some opportunities for what I feel like step number 7 is next step action plan. Where do we go from here? Is it a solution set that I myself as a practitioner can bring to the table? Do I need to team and partner and bring somebody else in? Step number 7 is next steps action plan of where do we go from here. So in summary, the 7-step investment interview is something that as an advisor, if they've teed up the 3 greatest risk factors the right way, the bridge into a conversation that's very disciplined, asset consolidation, asset allocation, the ethical needs analysis or conversational suitability, capital lifetime needs versus wealth surplus, any additional assets that are non-investable assets that might affect the way in which we invest these dollars, any initial ideas. I've been visiting with the client for now at least 30 or 45 minutes about these specific assets. What are some initial ideas or feelings that I might have? And then last but not least, step number 7, what are the next steps or the action plan? Where do we go from here with the information that we've gathered?